Welcome to today's webinar on agricultural credit conditions. I'm Haley Shenander of the Federal Reserve Bank of Minneapolis. Before I turn it over to our speaker today, I have a few housekeeping items. Slides for this presentation and a copy of the video link will be emailed to all registered attendees next week. Joe will be entertaining questions at the end of his presentation. If you have a question, please type it in the chat box on Zoom. We'd love to get your feedback at the end of this presentation, so please take a moment to fill out the brief 3-question survey that pops up in your Zoom window when you exit the webinar. And with that, I'll turn it over to Joe.
Thank you, Haley, for that introduction, and thank you to everybody who's joining us online this morning. If you haven't joined one of these webinars on agricultural conditions in the 9th District, I'll give you a brief description of the data that I'll be presenting. And I'm just going to kind of walk over what we can say about the state of agriculture in our region heading into the planting and the sort of busiest part of the growing season going into the summer here. Just a quick disclaimer I want to give that if I share any opinions today, I'm just sharing my own opinions and not necessarily those of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. And I'm going to do my best not to share any opinions just because that's not what you're tuning in to hear anyway. So before I get into the results of our latest agricultural credit conditions survey, I'll give a brief overview of what we can say about the size of agriculture in our regional economy. I'll give a quick review of what I mean by our regional economy as well. So for those of you who've tuned into these presentations on our ag survey, this is going to be a new portion just to kind of give a little bit more context about the size of agriculture in our region. And then I'll get into some details about the survey, what it is and how it works. And then I'll just go right into the survey results for the first quarter of 2023. And so as not to keep you in suspense, the general headline results of the surveys were that we saw continued growth in farm incomes. Farm and agricultural producers are in pretty stable, strong financial condition going into the growing season this year. We've seen continued growth in agricultural land values in the region, and the outlook for the region, however, by contrast, is a little bit more uncertain. I would describe it as cautious to negative, at least when we get into the outlook for farm income. So I'll get into some more detail on that in a moment. Just a little bit of information about our region, though. So the 9th Federal Reserve District that we cover at the Minneapolis Fed is made up of the states of Minnesota, North Dakota, South Dakota, Montana. Then we have the northwest portion of Wisconsin and the Upper Peninsula of Michigan. So for our purposes in these states, we're going to be looking primarily at those 5 states in the West. The Upper Peninsula of Michigan does have some agriculture, but compared to the other states in the region, its agriculture is not nearly as large of a player in the economy of that part of Michigan. So just to give you a little bit more context on the size of our agricultural sector in the region, people tend to think of this part of the country, the sort of north central US, the Great Plains states in the upper Midwest, as being pretty agricultural heavy, and that's true, at least if you look at what agriculture constitutes as a share of our GDP relative to the US. So you can look at these 2 pie charts here, and I'm just showing you a breakdown of gross domestic product. That's our sort of best measure of the output of the economy. And I've broken out agriculture along with forestry, fishing, and hunting. Those are the other categories that get lumped in the national income accounts. You can more or less ignore the latter 3. In our region, it's mostly agriculture that's going to be representing. We do have a large forestry industry as well, but agriculture looms large among those categories. And what you can see is that even though it's a relatively small portion of the economy overall in the 9th District states, if you add up those 5 states in the western part of the district, you get about 3.5% of total GDP. And that seems like a relatively small portion, but compared to the US, you can see it's a much larger proportion of our output in the 9th District relative to the US. And just to put it in magnitude terms, in 2022, we're talking about somewhere just south of $37 billion if you add up the contribution of these sort of agricultural sectors in those 9th District states. Just to put it again in a little bit more cash-friendly terms, these are some data from the USDA showing the value of cash receipts from all agricultural commodities. And I want to point out this is not just crops, but also includes livestock and animal products like milk and dairy as well. And you can see that it varies from year to year, and that's going to depend on production and also commodity prices. But typically, in real terms, in 2023 dollars, this tends to produce somewhere between 50 and $75 billion in those 5 states in terms of total sales revenue from marketing of agricultural commodities. So a pretty large amount of activity in our region. So that's a little bit of context on the size and the importance of this industry. And obviously, anybody from this part of the country knows that agriculture is certainly, very much a part of the culture of the region as well. So that's just a little bit of context for why we do this survey on a regular basis. We do this survey because of the importance of agriculture. We check in on a quarterly basis with agricultural banks in our region, that is, banks that are heavily concentrated in agricultural lending. We do this on a quarterly basis. I don't want you to think of these survey results as being a scientific survey. They're not based on a random sample, but rather I would think of it more as being sort of a panel of experts that we check in on a regular basis. So these are banks scattered across our region. They're going to be community banks or state banks that are heavily concentrated in ag, that do a lot of agricultural lending. And as such, they understand this industry pretty well. They understand how agriculture in their communities is doing well. They communicate with their customers, and they have a pretty good idea of what's happening in agriculture. So we do this 4 times a year. We release it 4 times a year. And we like to do these webinars a couple times a year, particularly in the spring and in the fall, kind of at the beginning of the growing season and at harvest time, to really get a good read on what's happening in the region. One last thing I'll say about the results I'm about to get into: this is covering the first quarter of 2023. So what we do in the survey is we ask what happened over the last 3 months compared with either a year earlier or the 3 months prior to it. And we do this survey after the end of the quarter. So this is really going to be covering the period from January through March, when farmers are really getting fully into marketing and selling their crops from 2022. And we get a good reading of farm incomes during that period. We conduct the survey itself in April, and so we just released it last week. And what we found from the first quarter survey is that farmers continue to be in pretty solid condition. And this has been true really since the waning period of the pandemic. We've seen strong commodity prices, and that's benefited farm households quite a bit. So we've seen continued strong income. The incomes that we saw in the first quarter of 2023 compared to a year earlier increase on balance. We also saw increases in household spending. However, capital spending by farms, purchases of equipment and buildings, was relatively flat overall. Some interesting context from the comments on that. Folks largely attributed that to supply chain issues and availability of equipment, as well as to higher interest rates that it's going to take to finance those purchases. We did see continued increase in interest rates, not surprising given the economic environment right now. Higher rate of loan repayment, kind of consistent with a relatively good cash position of farmers, and also consistent with that decrease in loan demand, farmers demanding less credit because they have more cash on hand. We saw continued increase in land values and rents from a year ago, and that's all good news. Looking forward, we also asked these lenders about their outlook for the coming quarter, and that was a little bit more uncertain. In fact, the income picture takes a negative turn, at least in the outlook. A lot of comments on what was going on behind that. A lot of folks pointed to an expectation for downward movement in agricultural commodity prices, and for persistently high input costs, kind of compressing those profit margins for farm operations. So how do these results actually break down? I'm going to move through some tables quickly so you can kind of see the breakdown. So we ask about farm income, we ask about household spending and capital spending, and we just give them a very simple sort of 3-option choice about whether they saw those things increase, decrease, or stay the same relative to a year earlier. So this is for Q1, for the first 3 months of 2023 relative to a year earlier. And you can see that just over half of the lenders told us that farm income increased. So majority of lenders seeing continued growth in farm incomes. But I want to point out this was a decrease from what we've seen in some of the recent surveys. Only 15% of them told us that farm incomes decreased. You can see the picture for spending by farm households is roughly similar. Slight majority telling us that farm spending increased, but capital spending is a little bit more flat on balance. Roughly somewhat equal a proportion reporting increases and decreases, and just under half of them telling us that farm capital spending was unchanged in the quarter. Just to put this in historical context, this is a long running series of charts. So we've been doing these surveys for more than 25 years on a quarterly basis, and you can kind of see a breakdown here of what the proportion is of respondents telling us that farm incomes either increased or were unchanged compared with a year ago. And so you can see that the period we've been going through since early 2020 has been a period of sort of consistently growing farm incomes, and that matches up with the last few cycles that we've seen in agriculture that you can see reflected in this chart here. So the period of the early 2010s, when we saw really strong commodity prices, was also marked by growing farm incomes. And then we had a long slump over the mid 2010s, which we just ended a few years ago. So you can kind of see the context, longer term context for some of these numbers, and you will see a slight dip down in the proportion telling us that they saw increased farm incomes this quarter. Not surprisingly, given the strong farm income picture, not a lot of demand for loans. So just under half of these lenders told us that they saw a decrease in loan demand. 2 in 5 told us that they saw increased repayment rates, and most of the rest said that they saw no change in repayment rates on loans. And renewal activity, that is the rolling over of existing farm loans, mostly unchanged in the period as well. And that's all consistent with pretty strong financial position of farms. We also asked some more detailed questions on this quarterly survey about borrower financial condition, and nearly every lender reported that the liquidity position of their customers improved relative to a year earlier. So not just higher incomes, but also higher net cash on hand. Looking forward to the second quarter, so we ask about what happened over the previous quarter, and we ask them to look forward into the coming 3 months. And as I mentioned earlier, that picture is a little bit more pessimistic. So you can see just under half of lenders told us that they expect a decrease in farm incomes in the second quarter of 2023. Only 20%, or just under a fifth, told us that they expect an increase in farm incomes going forward. So moderation in farm incomes expected. Generally speaking, a pretty stable picture for farm household spending. About a third told us they expect it to continue to grow, and just over half told us that they don't expect any change. Capital spending picture just about the same. On balance, expecting a slight decrease in capital spending, but the largest share told us that they don't expect any change in capital purchases of equipment or buildings by farm households. And then looking forward to how that translates into the business metrics for these bankers, expecting somewhat of an increase in loan demand, although overall, again, the majority of lenders, the largest share of lenders telling us that they don't expect any change in loan demand. Just over a third expecting loan demand to increase in the coming quarter. And again, that's consistent with some moderation in income that we expect to see as well. Overwhelmingly, no change expected in either the rate of repayment on farm loans or renewals. So why aren't we seeing stronger growth, expected growth in loan demand, given the relatively weak expectations for income? Well, part of the reason might be because it's more expensive to get a loan right now. So one of the things that we ask about on an ongoing basis is what the prevailing rate of interest is that these lenders are charging on their loans. For operating loans, for continuing operating loans for producers, for machinery, and for real estate loans. And not surprisingly, every one of these categories saw an increase in the first quarter of this year relative to the quarter a year before. And this has been an ongoing pattern for more than a year as the Fed has been increasing interest rates. We've seen interest rates across the economy increased, and that's affected farmers as well. And in the most recent quarter, we saw for each of the categories of loans that we ask about, we saw more than 20 basis point increase in the average average interest charged on these loans. That is more than a 0.2% increase in percentage point increase in the interest charged on agricultural loans. That ends up being somewhat of a concern for these lenders because that increases the cost of business for these farmers going forward, and that's going to weigh on their balance sheets and on their income picture as well. Even though we're seeing an increase in the rate of interest that's charged on these farm loans, still seeing continued growth in agricultural land values throughout the region. So once again, on a regular basis in this survey, we ask lenders what the prevailing cost is of an acre of good land in their area. And in this case, I'm showing you what they told us for non-irrigated cropland. That's kind of the largest class of land in most of our region. And across the region, on average, they told us that the value of an acre of non-irrigated farmland increased 12% in the first quarter relative to the same period a year earlier. So 12% annual change. That's pretty strong growth. I will point out that, again, if you compare to our recent surveys that we've conducted, this is a slowing rate of growth. So if I went back a year ago, earlier into 2022, the results we were getting for this question were more toward the 20% range. And again, it varies by state. You can see the different results by state in the picture here. Minnesota at 13%, the Dakotas, respectively, North Dakota and South Dakota at 11% and 9%. Across the region. So this is a slower rate of growth than we reported earlier in the year, but still 12% rate of increase in the value of an acre of land is pretty strong growth, relatively speaking. I do want to point out one other thing, which is when we calculate these averages, we're only comparing the lenders who responded both 1 year ago and in the most recent survey. So we're getting an apples to apples comparison. There isn't going to be a change in the value depending on the composition of who responded, if they were from different areas or things of that nature. So it is an apples to apples comparison. We're checking in with the same people and comparing to what they told us the value of an acre of land was in their area a year ago. So this is a pretty good measure, at least looking at those lenders who responded in the survey. When we look at cash rents, so we don't just ask about land values, but we ask what it costs to rent an acre of farmland in the region as well. There are a lot of producers who are growing crops on land that they don't own. They're renting it possibly from a neighbor, maybe somebody who's retired. Those are growing as well, not growing quite as much as land values are. So across the district, the cash rent on an acre of non-irrigated land went up 8%. Again, you can see the breakdown state by state: 9% in Minnesota, 8% South Dakota, 5% North Dakota, et cetera. But generally speaking, increase in the cash rent earned on an acre of land as well, and that's consistent with an increase both in the value of the underlying farmland and also the value of the commodities that can be produced on an acre of land. One last thing I wanted to share with you before I get into any questions that might be coming in the chat is a special question that we asked since it's the beginning of the year and we're just heading into the growing season for most commodities. We were curious what these lenders' biggest concern was for the year ahead. So we asked them what's their top concern for agricultural producers this year. You can kind of see the breakdown in this chart. Overwhelmingly, the largest concern among the lenders we surveyed was the volatility of commodity prices, sort of forward-looking uncertainty about whether the currently strong prices that producers have been benefiting from are going to obtain, whether they're going to be sustained or whether those are going to change going forward. The next most common concern was interest rates. As you can see, at 27% of the lenders responded that it was that rising interest rates was their largest concern for agricultural producers. And then just after that, you can see some of the other categories, the most significant being the cost of inputs or availability of inputs used in farming. And so that kind of gives you an idea of what the biggest concerns are going forward. Again, overwhelmingly, commodity price volatility is the biggest concern. So that's kind of a look forward. Once again, to kind of sum up, we're still seeing growth in incomes, but the forward-looking expectations for incomes are a little bit more moderate than what we've seen so far. And we're seeing a rising interest rate environment, which is leading to some concerns among producers about that and other costs of doing business. And so expectations going forward are a little bit more moderate. And the biggest concern overall is about whether or not those incomes are going to hold up. So with that, I am going to see, it looks like we maybe have a few questions in the chat, and we have my colleague Haley on hand to kind of moderate those.
Yes, for sure. So if you have questions, please type them in the Zoom chat box. And let's start with this one since we have a few already. When do you think interest rates will put some downward pressure on farmland? Or do you feel that the large amount of liquidity is pushing farmland higher and therefore the liquidity will have to leave the system before land values really soften?
Yeah, so that's a really difficult question to answer. I would say this. In some way, we're already seeing downward pressure on farmland. So as I mentioned, that annual rate of growth in farmland has come down. So even though it's still positive in the region, right now it's 12%. The last survey that we had, it was up at 18%. So just to give you an idea that, you know, the level of farmland obviously is still increasing. But that annual rate of growth has slowed down. And actually, if you look at the quarter over quarter change, it was practically negligible. So we're just comparing the price of farmland in the first quarter of this year to the first quarter a year ago. Most of that increase had already happened in 2022. So if you just look at the quarter over quarter change, and again, it varies by state and in our region, but if you look at the quarter over quarter change, that was pretty slow. So I would, in some way, you can say that it's put downward pressure, or at least moderating pressure on land values. Now, the questioner made another really good point, which is that a lot of the purchases that we're seeing are being carried out in cash because producers have more cash on hands right now. So to that, to the extent that a lot of purchases are being carried out with excess liquidity, that's going to blunt the effect of higher interest rates on downward movement in land values. And that's probably responsible for why we haven't seen a bigger correction, if you will, in land values.
Next up, we have someone's wondering if you can comment on changes in the number of farms or farm owners since 1 year ago. Have you observed any consolidation in the industry or things like that?
That's a really good question. We don't really ask about that in the survey. You're giving me a really good idea about a special question that I might want to put on the next survey, though. We always have the option to add additional questions. So we don't count in this particular survey the number of farms. The USDA does track the number of farms, and depending on the state, that's available at the state level. I will say that over the course of the year, you don't tend to see a lot of change from year to year in the number of farms, but over longer terms, there's obviously been a long-term decline in the number of farms that's been going on since the 1940s in the United States. I would expect that continued over the last year, but I can't actually give you a magnitude for that.
Next, we have someone asking, how do the land value and cash rent growth rates compare regionally to a national average?
So they're higher in the region than nationally. I want to point out, actually, just to put a quick plug for some of our colleagues around the system, the Minneapolis Fed is far from the only regional Federal Reserve Bank that does these surveys. So our colleagues in Kansas City conduct these surveys, and so do our colleagues at the Chicago Fed, among others, St. Louis as well. So you can go to their website, you can go to the Kansas City Fed's website or the Chicago Fed's website and see how they stack up. Generally speaking, to sort of abstract from our district, in the central part of the country, in the Great Plains and the Corn Belt, we've seen higher growth in land values than we have nationwide. So in Minnesota, for example, we saw land values increase more in Minnesota than they did on average nationwide, and that's partly due to the fact that the mix of commodities that are produced in Minnesota, particularly corn and soybeans, had seen really strong price appreciation over the last few years. So that's partly responsible for that. But you also see, for example, in Iowa, just south of Minnesota, even though it's not in the 9th Federal Reserve District, I'll just mention that Iowa also has seen pretty strong growth in land values, and they have a fairly similar mix of corn, soybean, and then hog production in that state, and that's all contributed to growing land values there as well.
Someone was wondering if we've asked about potential Title 42 impacts in the surveys or are thinking about doing that.
It's a good thing to think about doing, about asking about that, of course, just changed. And that's probably going to have some impact on on the supply of farm labor. And I'm imagining that's what the questioner has in mind. We haven't asked about that in the most recent survey, but that's another one for me to keep in mind. I'll make a little note to myself that we might want to ask about on the second quarter survey.
And finally, someone was wondering too if the survey results over time are available on our website, especially going back to the 90s.
They are actually. I'm glad you asked. So the survey results, you can find every time we publish the survey, we publish that chart, a version of that chart that I displayed that shows you agricultural incomes over time. And if you're, if you're an intrepid web searcher, you will be able to find previous releases on our website. But we don't necessarily report all of the metrics over time in one dashboard, but you can find all of our previous results on our website and comb through those as well.
Okay, great. And we have time for, it looks like, about one more question. As someone asked, your GDP chart shows that even in our region, agriculture is a relatively small portion of the economy, but it feels like it should be a bigger part. Why isn't it?
Yeah, it does. That's always surprising to people when you tell them that even in a state like Minnesota, that agriculture constitutes less than 4% of GDP in Minnesota. Part of that is, so there's sort of two reasons that I'll give for that. The first is that that it just sort of feels like it should be bigger. And that's, if you drive across Minnesota, most of Minnesota, when you drive across the state, you're going to see a lot of farms, you're going to see a lot of grain elevators. And just geographically, it's a part of the economy that even if it's a relatively small part of GDP, it takes up the most space, right? So there's kind of an incongruity there in what we see versus what's actually measured in the data. But the more important point to make is that there's a peculiarity of how we measure value added by industry in GDP. So the way that we measure or account for agriculture in GDP is just production agriculture. So literally, if you are growing corn, soybeans, wheat, or producing dairy or raising cattle, just the value of the commodities that you are producing minus the cost of the inputs to produce them is going to be what we measure in GDP. So there's all sorts of other agricultural impacts on GDP, which are measured in other categories. An example I'll give is obviously grain needs to be transported. So there's a huge milk needs to be transported. So there's a huge amount of transportation that happens around agriculture. There's a huge amount of processing that happens. Well, those are counted in the transportation component of GDP and in the manufacturing component of GDP. So agriculture in our region has bigger residual effects on GDP, but the way that we measure it in GDP is really just that sort of that production portion. The further on parts of the value chain we're measuring elsewhere. So that's also part of the incongruity. So if you were to actually account for all of those spillover effects or those other industries, it would be a much larger portion of our GDP. And then the thing I'll say about that is I think for our purposes in presenting these survey results, it's still relevant just because we're really asking about agricultural producers and the condition that they're in. So that's actually really kind of more directly relevant to the survey itself.
Great. Well, that was our last question for today. Thank you so much for joining us. More information will be on our follow-up email to this event. And please remember to fill out the brief 3-question survey that will pop up in your Zoom window upon exiting. And with that, I hope everyone has a great day.
Thanks, everyone.